Welcome to the Big Mike Fund Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome Eric Goodman to the episode. Hi, Eric.
Hi, Mike. It's a pleasure to be here.
Thank you again for coming as a repeat guest. I believe you came a while back, and feels like now it's the best time to bring you back because we are in New York City. And it's been a center of pandemic, and it's been a center of economic uncertainty in the recent days. So we're now sort of in the post-COVID world, and things are pretty dynamic now. So just would love to hear your thoughts. What do you see? What's happening right now from the deal flow, from your investments? And full disclosure, we invested with Eric from a couple of our funds, from Tempo Opportunity and Tempo Growth, into Goodman Capital Fund 2. Love working with Eric. He's a brilliant guy. Appreciate the opportunity to work with you. So let's just chat a little bit about your past investments, the new stuff that's coming up, where we're going, what's happening in New York City. So I'll let you have the floor.
Absolutely, Mike. Well, again, appreciate for having me on. And like you said, there's really, New York City has really become quite a dynamic environment since even prior to the onset of COVID, which our first reported case was back in March 1st. And I'd say that the onset since March has only made it even more interesting, particularly for this distressed debt space in which we've been investing. I guess for the benefit of those listening, Mike, I'll give you just a quick, as you know, we've been investing in New York City for the better part of the last 30 years. We're a multi-generational business focusing strictly on distressed commercial paper, particularly first lien paper, and particularly secured by existing, stable, liquid assets. These take the form primarily of multifamily assets. They are typically residential assets, but these are technically commercial properties. They're typically above 4 families. And so the types of debt in which we buy that's secured by this collateral has a particular nuance that we specialize in. So the types of assets that we've always invested in, existing stable quality multifamily mixed use residential assets are the same types of properties that are securing the loans today, which we're sourcing and investing in. Now, I guess what's interesting, if you look from March 1st to where we are today, New York City has undergone quite an interesting transformation, right? March 1st, we had our first COVID case confirmed. March 22nd, our governor implemented the stay-at-home or pause order, effectively putting a shutdown to all non-essential businesses. And that really is the catalyst for a lot of the distress, commercial-based distress you now see today. Thankfully, after just at the end of July, we finally exited phase 4 of the 4-phase reopening. And now most forms of commercial enterprise are open except for still gyms, movie theaters. There's still limited indoor dining. But beyond that, pretty much a lot of the other retail and commercial corridors have now been open. What's interesting is over that period, you've seen quite a bit of headlines, right? You've seen talks of migration leaving New York City and the impact that's had. I actually don't have a few interesting insights on that. But what you don't hear as much about is a lot of the big tech moving into the city, between Amazon, Facebook, Google, and Apple, and all those big players. You look at just last month, Facebook took over the former U.S. Post Office, 730,000 square feet. They took over the Farley Post Office. They now occupy over 2 million square feet. Amazon, over 2 million square feet. They picked up the Lord and Taylor building for $1 billion in March at the start of COVID. So for all the negative headlines you get, which you don't hear unless you're really in the local thick of things, is actually how vibrant the tech community is building up right now. And as a consequence, what you're going to see is that subsequent demand for housing. Yes, there's also discussion of migration out of the city to the suburbs, a lot of that, if you look into the U.S. postal data, it's interesting. I read an article last night about the Postal Service requests for mail forwarding rates. There were about 150,000 mail forwarding requests through September, just last month. And a lot of that is to Long Island, Connecticut, a lot of the second home communities, which suggests that excess, that phrasing of it is a lot overblown. And really, once you have a little more clarity of whether there's a second wave and perhaps post-political election, I think we'll see a lot more of that migration come back. So I think now is really an interesting time to be super selective on the assets that we're underwriting, because I think the future and the near-term futures actually look quite a bit brighter than the way the news casts it today.
Yeah, I appreciate that great explanation. This is very, very interesting point. So in the short run, it feels like a number of folks have left the city temporarily because all the kind of city activities that are magnet to tourists, magnet to local residents, the Broadway, the restaurants, the museums, the parks are sort of in this post-COVID world where they're shut down or operating at a very low capacity, and we're waiting for sort of a wave 2, which is already here in some form or shape. I'm in Brooklyn and kind of in the red zone, so we've entered this again, wave 2 shutdown. Schools are out. But I do believe it's temporary. New York City had 9/11, and for a couple of years it was tough. Downtown Manhattan, then came back as things restabilize. The real estate seems to come back. So I acknowledge and agree with that position that we're in this temporary dislocation, but on a long-term basis, it feels like when there is a good solution for COVID in the form of vaccine, and in the form of other therapeutics, the city will reopen. So let's talk a little bit about the difference between what you invest in and some of the kind of risk assets today. And the reason I call them risk assets is because they're pretty obviously at risk of financial default. There was an article the other day I forwarded you in the Wall Street Journal that many CMBS securities are trading at a discount because they are pools of loans secured by hotels, secured by some of the retail real estate that's suffering right now massively, and those bonds are trading at a discount, while the things you invest in these type of multifamily pseudo-commercial assets. They're technically commercial because they are more than 4 doors, but they are catered to the living sort of residential kind of environments or mixed use. So let's differentiate between the two. What's in massive pain in New York now, and what kind of assets are doing okay?
Absolutely, Mike. And even to harp on one of the points you just made with that article, which I appreciate you sending over, that article even highlighted really 2 main components. There are structural differences and asset-based differences between what we do and what the commercial assets that were discussed in the article. To your point, though, specifically, the assets that are feeling the most pain really lie in the hospitality and the retail sectors. Right, these are seasonal businesses as well as management-intensive businesses that are, of course, undergoing a real tectonic shift born from the political pressures and just those segments of the industry that have not been allowed to reopen as many others have. So you look at the prime retail corridors of Soho, the Upper East Side. A lot of those stores are still closed because of the pending shutdown. And just it's been difficult to attract certain tourist activity, right? Where we have certain, if you will, international travel, many travel restrictions, right? Barring foreigners from coming to the U.S. going abroad. That's impacting some of those sectors. Some of the hospitality has been repurposed. Some of the Upper West Side, some down on the Lower West Side of Manhattan. And there are certain partnerships with the Department of Homeland Services, which are now being used to house homeless shelters and other family shelters that will be repurposed, but there's going to be a bit of a lag in the lease-up periods of those. And there's other confounding variables that are really impacting that retail and hospitality sector, compared to, as you mentioned, the commercial assets in which we invest, which are nothing more than just multifamily dwellings, but they're deemed commercial assets, and for a very particular reason, when loans are originated to borrowers of commercial, namely multifamily owners with assets that are above 4 family, then we can charge certain terms and rates that we otherwise could not charge them on a personal loan or on a primary home residence. So the nuance there is really more legal in nature. These are really residential assets, and because of that, they're very stable and sticky, right? We're not underwriting against assets that are super premium, high-level condo, $10,000 a foot exit pricing, where those assets will be saddled and will sit until the market catches up and can saturate that kind of inventory. Are the units that are securing or occupying the buildings in which that secure our loans, right? We're talking, B minus, B plus type quality. These assets are going for sub $2,000 a foot. This is not super luxury. It's not inclusionary low income housing. It's typically that B minus to B plus type housing, which historically through all market cycles tends to be the stickiest and most robust. I'd say that's from an asset side, but then just on the structural side, if I may, the article highlighted one other interesting discrepancy between the CMBS side versus what we do. We're underwriting each of our loans are single asset loans, one loan secured by one piece of property, typically also a borrower guarantor. There's a lot of control over the loan workout process, whether it's foreclosure, working solutions out with the borrower to affect a certain result. CMBS securities are very nuanced, very complex securities, as you mentioned, are bundled by pools of loans. They're typically overseen and managed by servicers and sub-servicers. There's a labyrinth of fees to pay off these types of loans, and so that level of control is not there in the same way would be with a single asset loan, and that's another reason that accounts for their trading at discounts to book.
Yeah, that makes sense. By the way, just a couple of comments. It's funny, you say it's B-class assets in New York City and they're only $2,000 a foot. If you compare that to anywhere else, things don't trade at that type of price. But for the assets you invest in, what's most interesting? We had a call the other day, last Friday, we're going over the portfolio, and you made an interesting comment that the loans, because you invest in the loans, not in the equity of these, the loans are at about $1,000 a foot versus the collateral is 2,000 plus a foot. They're pretty safe, pretty defensive loan to value ratios. They're still New York prices. And these type of assets are townhouses in the Upper East or Upper West Side, which have very limited supply. So anyway, let's just shift forward a little bit on where you see things are going from new opportunities perspective. Are banks still giving people forbearance? Are they extending forbearance? Which point will some of the distressed assets seem to come to the market? Because a lot of investors have raised a ton of capital sitting and waiting for these great opportunities, but they are sort of not happening or have been very difficult to find because the banks are not aggressive at all selling the paper. I guess the regulators are giving them plenty of time to take it easy, not to allocate all kinds of reserves. So what do you see happening? We are recording this in late October. This will come out in about a month at that point, post-election. So let's leave election alone. And then, but what do you see happening from the opportunities to invest in great deals in the things you invest in New York?
Sure, Mike, it's a great question. And just broadly speaking, right, these periods of market uncertainty generally create limited periods of limited access to capital for two types of end users, right? There are borrowers who have approaching loan maturities and they're in need of a refi. But then don't forget the other side of the coin. As you know, Mike, there are other lenders who rely on certain bank warehouse lines of credit to fund their businesses. And both right now are in distress. Not surprisingly, the first wave, like we saw in the financial crisis, was the first wave of distressed private loans from the private lenders. We've been quite selective. As you know, typical underwriting, we identify loans that are at sub 65% loan to value. underwriting the post-COVID world, we've reduced that even further to right around 50% loan to value. And again, focusing strictly on liquid, income generative, existing multifamily mixed-use residential assets, nothing like the seasonal retail or management intensive like hospitality assets, which those have started to trade on the bank side of the portfolio. Banks have already been very quick to try and move some of the more retail and hospitality beaten down assets. But the core mixed-use multifamily assets, those have not traded as much from the bank side. We picked up a few earlier on this year, as you know, some very attractive multifamily assets right by the Guggenheim Museum at very attractive bases. These what I would think I would consider more unique and one-off in the broader scheme of what we had anticipated the pipeline to look like from the traditional bank lender. As I mentioned, in contrast to the financial crisis, we haven't seen that strong uptick in activity of traditional lenders picking up a lot of their product, at least not to the extent we expected. But that raises a question because we do see quite a bit of product from the private lender universe. And so there is a certain conformity of underwriting. And it does raise the question, if the private lenders are inundating us with their bad loan portfolios, what's going on with bank asset quality? And that brings me to the CARES Act, which, as you know, was released on March 27th of this year, right after the onset of COVID, and actually a subsequent regulatory guidance that was released a few weeks later on April 7th by the major bank agencies, namely the Board of Governors of the Federal Reserve, the FDIC, Controller of the Currency, and the Consumer Financial Protection Bureau. And I want to focus on one quick particular section of the CARES Act, and that's Section 4013. Or more formally known as the Coronavirus Aid, Relief, and Economic Security Act, which established some very favorable bank treatment for troubled debt restructurings. And for your viewers, I want to explain what that is. A TDR occurs when a bank restructures a loan and offers a concession of some of the loan terms that it otherwise wouldn't have otherwise made to a borrower. That could be a reduction in interest rate, accrued unpaid interest, or principal amount of the loan. Think of TDRs as extreme loan modifications. And here's why they're important and why they're relevant to know it insofar as the CARES Act is concerned. Provided banks made these extreme loan modifications before the anticipated borrower default resulting from COVID-related distress, Section 4013 of the CARES Act allows banks to report these loan modifications as performing loans and not as TDRs, which carry very burdensome risk weighting when it comes to calculating a bank's risk-based capital threshold as required by the bank regulators. This is huge because unlike during the financial crisis where banks were coughing up bad loans tenfold, today the regulatory environment allows banks to mask poor asset quality and whitewash a sub or non-performing loan as performing. And the regulatory guidance released a few weeks later on April 7th further applies the masking to general non-accrual loans, which occur when a borrower has failed to make a payment for 90 days. So this general regulatory framework is single-handedly responsible for why you don't see this deluge of non-performers in the bank books, provided that they were able to make, as many banks were, loan modifications in advance of that default. But there's good news, and there's a silver lining to the story. And that is, under the CARES Act, the TDR and non-accrual exemption lasts only until the earlier of 12/31 of this year, or 60 days after the designation of COVID is no longer a national emergency. So right now we're in active dialogue with our bank lenders with whom we've worked for many years. And from what I hear, while they were extending forbearance in March, many offered the typical 3-month forbearance start in March. They re-upped again in June. We're coming to the end of the line. And I think we're going to have a very busy year end and even busier start to the early next year with a lot of the bank product that I think is going to start hitting the market. And we're pretty excited for it.
Yeah, that's a very detailed view on what's happening with bank assets and how the CARES Act has given them a get out of jail card for the time being until you said December 31st or the governor declaring the end of the state of emergency related to COVID. So it feels like the deal flow will be improving effectively at the very end of this year and into the 2021, because unless they extend it, you never know. Politicians can try to jam in some kind of extension. Although after the election, there's less motivation to, depending on what happens with the election, there may be more extension or not. It's hard to say, but we shall wait and see. Let's continue chatting. So kind of interesting. The supply of the product that you invest in is limited. There's a massive oversupply of condos, and hotels obviously distressed. Any retail related to travel, related to people coming into Manhattan to work, to enjoy their leisure time, all of that is in deep distress. Are you seeing any interesting opportunities there, or it's more of at this point really distressed situations? Because these type of assets, it'll take a lot of capital to keep them afloat. So as you know, we've made some investments in conversions of hotels to affordable housing. Not sure if it's applicable here in New York. We've done investments outside of New York. It's obviously an interesting thought here, but the supply of units of condos is high, and these hotels, I don't know if the conversion would make any sense because of the alternative supply. Just curious if you have any thoughts on, are you going to see any interesting opportunities buying that paper, or at this point it's very speculative? You'll know when you see it.
Well, I think, Mike, it's a great point, and I'm always very impressed by your creativity with repurposing assets. You're really second to none on that front. In New York, it's a little, as you know, it's a little challenging because of very stringent zoning rules and regulations to convert hotel to resi. It is done on occasion. I mean, the most notable one I might say is probably the Waldorf Astoria was converted to condos. You see a little bit more of office to resi condo conversions. You've seen that a lot more now down in the financial district. That's been an interesting play. What I think will be particularly unique and certainly an area of focus for us, we have a few deals right now that we're eyeing, has been new completed construction on condo inventory that's not selling. So as soon as you have a condo project that's built and there's a certain percentage that's been sold, that becomes a very difficult to finance asset. And particularly of the institutional quality sponsors who now are stuck with semi-sold condo buildings, they're only out as a condo inventory loan, and those can get very expensive. So in our purview, we're very much focused, and we like to think of ourselves as basis buying. So if the loan basis is in at a sub-replacement cost basis, that becomes a very attractive asset. I don't think the space for us, we don't have the, I don't think we would add as much value to a hospitality-oriented conversion, but there's plenty, a superfluous amount of resi condo construction that's gone up, where we're pretty much waiting in the wings, working with our bank and private lender universe to sit and be pretty selective when those loans come to maturity, because we're fairly confident those sponsors, as we've seen already in the Upper West Side, some pretty notable developers, without naming names, a few condo and co-op buildings have gone, and you've seen a number of UCC foreclosure auctions in the Upper West Side and the West Village in areas that historically have been have not seen any such financial distress. Today, you're seeing that particularly by the High Line as well. You have a few other new developers that are struggling. So we're pretty much, I don't want to say licking our lips, waiting in the wing, but we're certainly going to be very opportunistic and jump on those opportunities as they present themselves.
Yeah, that's a great point. I remember we've gone to a number of these assets in Brooklyn, and I remember the one on the Newkirk Avenue. We looked at a newly constructed condo building where the units are just not selling fast enough, and developer is pressured because their loan has matured, and they were thinking they could move these condos fast, and now there's a massive oversupply. So the opportunity is to come to these matured loans and I guess buy them from the banks who probably want the monkey off their back anyway. So
completely. And the nice thing about these assets, Mike, is, and why we have a particular focus on the multifamily mixed use sector, is that they're very liquid. What that means, not in terms of transactional value, in terms of exiting, but to reclaim those assets post foreclosure, operate, lease up, refinance. There are many tax favorable treatments for leasing up and not executing a condo plan, and provide that our loan basis is in at the right investment to value threshold. that can be a very attractive investment to own as a rental, refi, and hold until the market turns.
Yeah, I mean, that's the reason I like your investment strategy. Is instead of building a new condo, you could buy distressed debt on a newly built condo, and you are at 50% cost basis, 55% cost basis. You would love to get that building if you could. So it's a whole, it's a very cheap access point if you can get can get in. So that makes sense. That sounds like a great opportunity. We have 5 minutes left. Any other commentary, thoughts? Totally, the floor is open. Kind of anything you want to talk about. Any great ideas on you're going to launch Fund 3? I know Fund 2 is closed and been closed for a while. I know you've been doing the funding of the performing loans with a backstop. If they default, you could buy them into the fund. I love that idea. That's a very powerful idea because investors in the performing loan have an assurance if a loan goes bad, you're happy to buy it, and it's a good it's a good match. Any interesting thoughts on this? Any comments?
Mike, it's you kind of took the words right out of my mouth there. I was going to mention with Fund 2 near full deployment and realizations coming in early next year, we're getting ready to launch two things. One will be our third fund, which will be again a similar model as Fund 2, a distressed debt oriented vehicle targeting non-performing loans, accruing our standard default rates up to 24% per annum, focusing again strictly on first lien senior commercial paper here in our local New York City market. In tandem with that, we'll also be launching we'll likely also launch a separate vehicle, as you mentioned, that will be more a more liquid credit strategy. So that will be performing bridge loan originations that, as you mentioned, will be backstopped by Fund 3. And so what that means is we'll originate new paper secured again by the same kind of strict underwriting criteria that underlies our distressed debt strategy, except this will be a more liquid-driven strategy for folks looking for current income. And if and when those loans default, Fund 3 will have the exclusive opportunity to buy those loans for par, returning back investors' principal in the liquid strategy. And I think those two I think the two vehicles will be very, as you mentioned, synergistic with each other. It'll provide us with opportunities to originate to institutional quality borrowers who otherwise are having difficulty accessing capital in these uncertain markets. So there'll be that liquid strategy. And then if and when those loans default, that will be a very organic transition to the defaulted distressed debt investment strategy. And we'll start to accrue those high rates of default interest. And between the two, I'm excited to launch those two vehicles in the early part of next year. Yeah,
that's great to hear. They're great complementary funds or products. So I appreciate you sharing. How would folks get a hold of you? We're kind of running out of time. If anyone had questions that were interested to invest or had some other things, is there a good website or email or another way to get a hold of you?
Yes, the two probably best ways to get a hold would be through our website, which is www.goodmancapitalllc.com, or directly via email at invest@goodmancapitallllc.com. And of course, they can always go through you, Big Mike.
Thank you, Eric. Appreciate your time and your wisdom. Great to have you on the podcast. And stay well and safe, and we'll do another episode, hopefully at a better times when New York City is doing well and prosperous, and we are New Yorkers for a long time, and it's a great city, and I believe it will come back. So that's that's the wisdom.
And I'm looking forward to having you out with me, Mike, on one of our next site tours. We're gonna have a
I gotta go for a walk. I need to walk more. So when post-COVID, we'll walk Manhattan or wherever we're gonna walk. So until that time, thank you kindly.
Thank you, Mike.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.